Imagine you are tasked with defending a massive, sprawling fortress.
Okay, I'm picturing it.
Right. And in the old days, the strategy was pretty straightforward, right? You just built a thicker stone wall.
Yeah, or you dug a deeper moat.
Exactly. You post some sentries on the ramparts, and you just watch the horizon for the invading army.
Because the threat was visible. I mean, it was physical.
Right. It moved at the speed of a marching column. You could literally see it coming.
You had days, maybe even weeks, to see the dust kicking up on the horizon before the siege actually began.
Yeah, but you'll step into the modern financial system, and suddenly that stone wall is just completely useless.
Totally obsolete.
Right. Because what happens when the attack isn't an army, but like a sudden algorithmic panic?
Oh, yeah.
What?
A panic that triggers a massive liquidity drain in, what, milliseconds?
Milliseconds, or, a coordinated cyber assault on your payment gateways originating from 3 different continents at the exact same time.
Which is happening all the time now.
It is. Or perhaps even more dangerously, it's a slow-moving abstract threat. Like a multi-decade climate transition that just quietly rots the underlying valuations of your corporate loan book.
Right, the stuff you don't see until it's too late.
Exactly. You cannot just build a wall anymore. You need a highly sensitive, predictive nervous system.
A nervous system. I like that analogy.
Thanks. And that is exactly what we are looking at today on this deep dive. The blueprint for how the Reserve Bank of India is trying to build that exact nervous system before the next global shock hits.
And it's a very specific, highly technical blueprint.
It really is. So for you listening, if you are prepping for your regulatory exam or maybe a major professional boardroom briefing, this is your mission today. We are going deep into Chapter 6 of the RBI's annual report for 2025-26.
Covering regulation, supervision, and financial stability.
Yes. We are going to unpack this so you don't have to sift through the dense policy yourself. We have 5 main pillars today. So, financial stability, regulation, fintech, supervision, and enforcement.
And, what makes this specific period, this 2025-26 window, so fascinating is the RBI's dual approach.
The dual approach, right. Break that down a bit.
Well, it's a watershed moment.
Mm-hmm.
On one side, they're conducting this massive, almost historical cleanup. I mean, ripping up decades of legacy regulations to reduce friction.
Right, just getting rid of the red tape.
Exactly.
Yeah.
But simultaneously, they are aggressively deploying cutting-edge technology.
Like AI and all that.
Yes.
Yeah.
Artificial intelligence,
Yeah.
machine learning, probabilistic data analytics. They are trying to predict systemic crises before they even materialize on a balance sheet.
Wow. So it's radical simplification layered with extreme technological sophistication.
That's a great way to put it, yeah.
Okay, let's start with the entity tasked with actually seeing those threats on the horizon, the Financial Stability Department or the FSD.
The radar system for the entire Indian economy.
Right, the radar. Their core mandate is macroprudential surveillance. So they aren't just sending auditors to look at the books of a single bank, right?
No, not at all. They are analyzing the entire interconnected web of the financial system.
And they serve as the secretariat to the Financial Stability and Development Council subcommittee, the FSDCSC.
That's a mouthful.
It is, yeah. But they publish the half-yearly Financial Stability Report, which is basically the definitive collective assessment of macro-financial risks to the country.
Right, and the FSD operates on this premise that systemic risk is rarely obvious in isolation.
What do you mean by that?
Well, a single bank might look perfectly healthy, right? But its interlinkages might make it a conduit for a systemic collapse.
Ah, okay. The domino effect.
Exactly. And looking at their agenda for this reporting year, the shift in their stress testing methodology is a huge signal.
Right. This is a big exam highlight for you listening. How has their risk modeling evolved?
Historically, macro stress tests were reserved almost exclusively for the massive scheduled commercial banks.
The classic too-big-to-fail institutions.
Yeah. The assumption was, if you secure the apex predators of the banking ecosystem, the rest of the food chain is totally safe.
But 2025-26 sees a total inversion of that logic, right?
A complete 180.
Yeah, because the FSD developed an in-house liquidity stress test specifically designed for non-banking financial companies, the NBFCs.
And they didn't stop there, actually.
Right. They explored extending these macro stress tests down to Tier 3 and Tier 4 urban cooperative banks, the UCBs.
Which is wild if you think about it.
It really is, because from a systemic risk perspective, I look at a Tier 4 UCB,
Right.
which operates in a highly localized geography. It has a tiny balance sheet.
Very small.
Yeah, so I have to ask, Why is the apex regulator burning expensive computational resources to stress test a local co-op?
Because contagion in a highly digitized financial system no longer respects the traditional hierarchy of size.
Wow, size doesn't matter for contagion anymore.
Right. It's a direct acknowledgement of modern dynamics. A liquidity crunch doesn't have to start at a massive commercial bank to cripple the system.
It can start at the grassroots level.
Exactly. Just think about the business model of many NBFCs. They borrow from wholesale markets.
Right. Often securing lines of credit from those exact same large commercial banks.
Yes. And then they lend to retail segments or small enterprises that, frankly, commercial banks might deem too risky or operationally annoying to service.
So the NBFC is acting as a bridge, like a transmission mechanism between the massive commercial banks and the granular retail economy.
A highly leveraged bridge, yeah.
Hmm.
So run a hypothetical stress scenario.
Okay, let's do it.
Say a localized economic shock hits a specific sector, like real estate developers in a Tier 2 city.
Okay, so the local builders are struggling.
Right. A cluster of Tier 3 UCBs and local NBFCs heavily exposed to that market suddenly face massive defaults.
The builders can't pay them back.
Exactly. So the NBFCs experience a severe liquidity crunch. They cannot roll over their commercial paper or meet their repayment obligations to the large commercial banks.
And suddenly the large commercial bank has a hole in its balance sheet.
Right. Not because it made bad loans directly, but because the grassroots intermediaries failed.
Wow. So by pushing liquidity stress tests down to the NBFCs and the smaller UCBs, the RBI is establishing visibility into the capillaries of the financial system.
Capillaries, yes.
Yeah.
Rather than just monitoring the major arteries.
Because a blockage in a capillary can eventually trigger a massive systemic stroke.
Exactly. It's brilliant.
I see the logic. It's moving the early warning system closer to the actual point of economic friction.
Very proactive.
But, as analytical and forward-looking as that is, the FSD applied that exact same predictive lens to a threat that most people still categorize under environmental policy rather than hard financial risk.
Ah, yes. Climate transition risks.
Yes. The report details that the FSD assessed major carbon-intensive sectors using the Scope 1 emissions data of listed companies.
Which is a huge deal.
Right. They essentially ran hypothetical stress scenarios to see how these physical emissions could impact the balance sheets of the banks lending to these companies.
It is a fundamental repricing of risk. To ground this in the mechanics, Scope 1 emissions are the direct greenhouse gas emissions that occur from sources controlled or owned by an organization.
So we are talking about the literal smoke coming out of a cement manufacturer's factory.
Exactly. Or the exhaust from a logistics company's fleet of trucks.
Okay.
For decades, a bank's credit risk committee looked at a heavy industrial borrower and evaluated cash flow, collateral quality, and, historical repayment behavior.
Right. If the cash flow was strong, the loan was approved. Simple as that.
Yes. The carbon footprint was entirely external to the financial equation.
It was a problem for the environmental ministry, not the credit risk officer.
Exactly. But the FSD's modeling completely shatters that firewall. They're translating environmental data into hard, quantitative financial risk metrics.
So how does that transmission mechanism actually work in the real world?
Well, if you're a bank heavily exposed to a major carbon-intensive sector and global or domestic green regulations suddenly tighten.
Like a stringent carbon tax is implemented?
Right, or emission caps are strictly enforced. The operating costs for your borrower skyrocket overnight.
Or worse, their core technology just becomes obsolete, leaving them with what we call stranded assets.
Yes, stranded assets.
Like a coal-fired power plant might have 30 years of operational life left on paper, but if the regulatory environment forces a transition to renewables...
That plan becomes a massive liability long before the loan is paid off.
Wow. So the cash flow projections the bank relied upon just disintegrate?
They evaporate. The borrower defaults, the collateral, which is a highly polluting factory, is virtually unsellable because no one else wants the regulatory burden either.
And the bank takes a massive haircut.
Exactly. So the FSD isn't just looking at the direct impact. They are analyzing the spillover effects across the whole banking sector.
They are quantifying how a sudden regulatory shock to carbon-intensive sectors degrades the asset quality of the entire financial system.
Yes. It forces banks to realize that climate change is not just an ESG reporting exercise.
Right, it's not a PR thing.
No, it is a core balance sheet risk that must be provisioned for today.
That fundamentally changes the definition of creditworthiness. A company with incredible cash flow today is a subprime credit risk tomorrow if their business model is environmentally unviable.
Absolutely.
Speaking of sophisticated modeling, there is another tool the FSD rolled out in 2025-26 that deserves a real deep dive, the growth at risk model.
Ah, the GAR model.
Yes, for you studying for the exam, remember GAR. The report notes they developed this utilizing the International Monetary Fund's framework.
Which is a very robust framework.
And the stated objective is to estimate how current financial vulnerabilities impact the future distribution of India's GDP growth. Break down the mechanics of this model for us.
So the growth at risk, or GAR, framework is really a masterclass in shifting from point estimates to probabilistic forecasting.
Okay, what does that mean in plain English?
Traditionally, economic forecasts deliver a baseline number. A central bank or an agency might declare, we project GDP growth for the next fiscal year to be 7%.
Right. A single point estimate based on the mean or median of expected outcomes.
Yes, but a single number tells a policymaker absolutely nothing about tail risks.
Yeah.
The low probability, high impact events.
It gives you a false sense of security, doesn't it?
Totally.
It tells you what is most likely to happen on a sunny day, but it doesn't tell you how bad the storm will be if a hurricane hits.
That's a perfect way to put it. So exactly how the methodology addresses this is through quantile regression.
Quantile regression, okay.
Yeah. The GAR model doesn't just predict the mean. It links current financial conditions, metrics like credit spreads, asset valuations, leverage ratios, and systemic liquidity to the entire distribution of future growth outcomes.
So we are essentially mapping a bell curve of future GDP and then observing how that curve mutates based on the financial stress we see today.
That is the exact visual to hold on to.
Mm.
If financial vulnerabilities are high, say, credit spreads are widening aggressively, indicating lenders are demanding much higher premiums for risk, the GAR model will mathematically demonstrate that the left tail of the GDP distribution has grown fatter.
The left tail being the area of the curve that represents severe economic contraction or recession.
Yes. It mathematically quantifies the downside risk.
Right.
So the model might reveal that while the baseline growth forecast remains at 7%, the probability of growth falling below 2% has actually tripled due to building financial vulnerabilities.
Oh, wow. So it allows the RBI to preemptively deploy macroprudential policy tools.
Preemption is the whole point, yeah.
If they see the growth at risk increasing significantly, they can tighten capital requirements or increase provisioning norms well before the baseline indicators actually turn negative.
It is an incredibly sensitive, rigorous early warning system.
But, building an early warning system, modeling climate impacts, running probabilistic GDP forecasts, that is all purely theoretical if the underlying rules governing the banks are outdated.
Oh, entirely.
Right. If a bank is operating on accounting standards that allow it to hide its vulnerabilities, the FSD's radar is just bouncing off a smokescreen.
A very thick smokescreen.
Yeah. The predictive apparatus requires an enforceable, modern rulebook. And that transition brings us to the second pillar today. The monumental structural shifts driven by the Department of Regulation, the DOR.
The DOR is basically the architect of the regulatory perimeter.
Right.
They govern commercial banks, cooperative banks, NBFCs, credit information companies, and all India financial institutions.
That's a massive mandate.
It is. It's a perpetual balancing act. They have to ensure a robust, healthy financial system while simultaneously dispensing cost-effective and inclusive services to a rapidly growing economy.
And the sheer volume of their output in 2025-26 is staggering. But one initiative stands out as a generational shift in regulatory architecture.
The consolidation exercise.
Yes, another major exam highlight. The consolidation exercise. The numbers are almost hard to comprehend.
They really are.
The DOR took over 11,000 existing circulars and instructions, some of which probably dated back decades, right?
Oh, absolutely. Back to the 90s, at least.
And they distilled them down into just 244 master directions, covering 11 different types of regulated entities.
Just an incredible feat of administrative engineering.
And they paired this with a new regulatory review cell, an advisory group on regulation, and launched a digital platform called Connect to Regulate.
To understand the magnitude of this achievement, you really have to understand the nightmare of the legacy system.
Paint that picture for us.
Well, for decades, regulatory instructions in India, as in many jurisdictions, were issued chronologically and reactively.
Like a Band-Aid approach.
Yes. If a specific crisis hit in 1998, a circular was issued. If the market evolved in 2005, another circular was layered right on top of it.
So if you were a compliance officer at a major commercial bank trying to construct a product that touched, say, priority sector lending and foreign exchange,
It was a nightmare. You had to sift through hundreds of overlapping, sometimes directly contradictory circulars spanning 30 years.
you would have to employ a small army of lawyers just to figure out which clause from 2012 superseded a caveat from 1994.
Exactly. The compliance burden alone acted as a massive tax on innovation and operational efficiency.
So this consolidation into 244 master directions, it's like the ultimate defragmentation of the regulatory hard drive.
That's exactly what it is. They unpacked a chaotic warehouse of rules and reorganized it into clearly labeled thematic aisles.
Right, so if you need the rules on capital adequacy for an NBFC, you go to one specific master direction.
Yes. It reduces the surface area for compliance errors and dramatically lowers the operational costs for regulated entities.
And they are digitizing the entire interaction layer between the regulator and the banks through the RAMS project, right? The Regulatory Application Management System.
Correct. The report notes phase 1 is actually completed.
So what does RAMS do?
It shifts the paradigm from a paper-based opaque approval process to a digital lifecycle approach.
Okay.
So if a bank wants to open a new branch, launch a new digital product, or seek an exemption, the entire application, tracking, and approval process is handled through this centralized digital nervous system.
It accelerates the plumbing of regulatory oversight. That's fantastic.
It really is.
So the format of the rules became simpler and digital, but the substance of the rules became significantly more rigorous.
Much more rigorous.
And the centerpiece of this rigor, arguably the most important policy shift in the entire annual report, is the finalization of the expected credit loss, or ECL, framework.
A massive tectonic shift.
Yes. The final directions were issued in April 2026. This mandates a hard shift to a forward-looking provisioning approach utilizing the effective interest rate method.
And it comes complete with a staging framework for asset classification.
Right. We need to unpack the mechanics of this extensively, because this fundamentally alters how bank profitability and capital adequacy are calculated.
It does. And to grasp why this is so critical, we must dissect the flaws of the system it is replacing, the incurred loss model.
Okay, let's talk about the incurred loss model.
Under that legacy model, a bank only created a provision, which means taking a hit to their profit and loss statement to set aside capital to cover a bad loan after a specific trigger event occurred.
Right. A trigger event being something undeniable, like the borrower missing a payment for 90 days.
Or declaring bankruptcy.
Right.
The core philosophy was completely backward-looking. The regulator required hard, observable evidence of impairment before forcing the bank to take the loss.
And what was the problem with that?
The catastrophic flaw in this model was exposed during the 2008 global financial crisis. Banks held massive portfolios of mortgages and corporate loans that were obviously deteriorating as the macroeconomy faltered. But because the borrowers hadn't technically defaulted yet, the banks didn't have to provision for them.
So the banks looked artificially healthy on paper right up until the exact moment they collapsed.
Yes. The criticism of the incurred loss model was always that it resulted in provisions that were too little too late.
It incentivized delayed recognition of reality.
Exactly. But the expected credit loss framework forces reality onto the balance sheet on day one.
How so?
Under ECL, the moment a bank issues a loan, they must immediately estimate the credit losses they expect to experience over the life of that loan.
Wow.
And they must provision for a portion of that expected loss immediately, even if the borrower has a flawless credit history at the time of origination.
Okay, let's break down the staging framework mentioned in the report, because that dictates exactly how much capital the bank has to lock away, right?
Right. The staging framework categorizes every single loan based on the evolution of its credit risk since initial recognition.
Okay, so what's stage one?
Stage 1 consists of performing loans where the credit risk hasn't increased significantly since the loan was originated.
Pretty standard.
Yeah. But for Stage 1 assets, the bank must calculate and provision for the expected credit losses that might occur from default events over the next 12 months.
Wait, so even for a perfectly healthy loan, the bank is forced to take a mathematical probability of default over the next year, multiply it by the loss given default, and set that capital aside immediately.
Exactly right.
That's incredibly strict. What happens if the macroeconomic environment sours or the specific borrower starts showing signs of stress?
That triggers a migration to Stage 2.
Okay.
Stage 2 includes loans where credit risk has increased significantly, even if there is no objective evidence of impairment yet,
So like maybe the borrower's industry is facing headwinds.
or their internal cash flow projections have weakened. The moment a loan hits stage 2, the provisioning requirement explodes.
Really? How much?
The bank must now provision for the expected credit losses over the entire lifetime of the loan, not just the next 12 months.
Oh, wow. That is a massive capital hit.
Huge.
If you have a 15-year corporate infrastructure loan and it moves to stage 2 in year 3, the bank suddenly has to provision for 12 years of potential expected losses.
Yes, which forces banks to be incredibly proactive in restructuring or exiting risky exposures before they migrate stages.
Because they don't want to lock up that much capital.
Exactly.
And what about stage 3?
Stage 3 is for loans that are actually credit impaired, the traditional non-performing assets where default has actually occurred.
So the worst case scenario.
Right. Lifetime expected credit losses are recognized here as well, but the interest revenue calculation changes to reflect the net carrying amount.
Which brings us to the other highly technical component mandated by the door, the effective interest rate, or EIR, method.
Yes. EIR. How does EIR fit into this forward-looking accounting structure? Let's use a tangible example to explain this.
Okay, great.
Suppose a bank issues a 100 crore rupee corporate loan, and to sweeten their quarterly earnings, they charge a massive 2 crore rupee upfront processing fee.
Very common practice.
Right. So under older accounting models, how is that handled versus the new EIR method? Well, under simpler legacy accounting models, the bank might recognize that entire 2 crore rupee processing fee as income on day one.
Oh, so it makes their quarterly profit look fantastic.
Exactly. It boosts executive bonuses and stock prices, while the actual risk of the 100 crore loan sits on the balance sheet for the next 10 years.
That creates an enormous incentive to originate risky loans just to harvest the upfront fees.
Right. Front-loading the reward while deferring the risk.
So what does the effective interest rate method do?
It mathematically eliminates that arbitrage. EIR is a mechanism to calculate the amortized cost of a financial asset and to allocate the interest income over the relevant period.
So they can't just take the 2 crore right away.
Exactly. Under EIR, that 2 crore upfront fee cannot be recognized on day one. It must be factored into the overall yield of the loan and amortized smoothed out over the entire 10-year life of the asset.
Alongside transaction costs and premiums, I imagine.
Yes, all of it smooths out.
Wow, it provides a brutally accurate picture of the loan's true economic yield. You can't mask long-term risk with short-term fee generation anymore.
No, you can't. And implementing ECL and EI requires banks to possess highly sophisticated statistical modeling capabilities.
They have to integrate macroeconomic forecasts, like the GAR model we discussed, directly into their daily accounting systems.
It is a painful transition for the banking sector, honestly, because
Yeah.
it inherently increases provisioning and reduces upfront recognized profitability.
Right. But from the regulator's perspective, it builds a massive buffer of capital inside the banking system during good times, which can be drawn down during bad times.
It makes the system countercyclical.
And the door didn't just fortify the credit risk accounting, they made crucial adjustments to liquidity defenses as well, specifically regarding the Basel III liquidity coverage ratio, the LCR.
Yes, liquidity is just as important as capital.
The report states they amended the norms to include haircuts on high-quality liquid assets, or HQLA, and revised the runoff rates for certain categories of deposits. To understand why this was necessary in 2025-26, we have to look back at the global banking tremors of early 2023, specifically the collapse of Silicon Valley Bank in the United States.
The SVB collapse fundamentally altered regulatory assumptions regarding the speed of a bank run.
Because it happens so fast.
Unbelievably fast. The liquidity coverage ratio was originally designed after the 2008 crisis. The formula is relatively straightforward.
Okay, what is it?
A bank must hold a stock of unencumbered high-quality liquid assets, things like government bonds and central bank reserves, that is at least equal to its total net cash outflows over a 30-day stress scenario.
So the numerator is the HQLA, and the denominator is the assumed cash outflow.
Correct. And the assumed cash outflow is determined by runoff rates.
The percentage of deposits the regulator assumes will flee the bank during a panic.
Exactly. Historically, regulators assumed retail depositors were sticky. They assumed maybe 5 or 10% of retail deposits would leave in a 30-day crisis.
Because, physically standing in line at a bank branch takes time.
Right. But in 2023, we saw that assumption completely destroyed. Billions of dollars exited institutions in a matter of hours.
driven by panic spreading virally on social media platforms.
and executed instantaneously via mobile banking applications.
Right. The bank run was digitized. It moved at the speed of a retweet.
That's exactly it. Consequently, the door recognized that the legacy runoff rates used in the denominator of the LCR calculation were dangerously low for the modern digital era.
So what did they do?
By revising these runoff rates upward for certain deposits, especially large institutional or highly connected digital deposits, the RBI is mathematically increasing the assumed 30-day cash outflow.
Which forces the bank to hold a larger pile of high-quality liquid assets in the numerator to maintain the required ratio.
Yes. But the door also attacked the numerator itself by mandating haircuts on those liquid assets.
Okay, let's explain haircuts.
The LCR assumes that in a crisis, a bank can sell its government bonds to generate the cash needed to pay fleeing depositors.
Makes sense.
But what happens if every bank is facing a run and trying to sell their government bonds at the exact same time?
Oh, basic supply and demand. The market gets flooded with bonds, and the price of those bonds plummets.
The fire sale dynamic. SVB failed largely because they had to sell their liquid assets at a massive loss to meet withdrawals, totally wiping out their capital.
So how does the door's introduction of haircuts address this?
The regulator's basically telling the banks, you might hold government bonds with a face value of 100 million rupees, but we assume that in a systemic panic, you will only be able to sell them for 90 million.
We are applying a 10% haircut to your HQLA calculation.
Exactly.
So by squeezing the denominator with higher runoff assumptions and slashing the numerator with asset haircuts, the door is forcing Indian banks to construct a liquidity fortress capable of withstanding a coordinated digital speed run.
That's the goal.
That covers the macroprudential regulations, but the door also zeroed in on highly specific, granular operational loopholes that corporate borrowers use to game the system.
Oh, yes. They got very specific here.
Let's look at the new rules surrounding current accounts, specifically cash credit and overdraft facilities. The RBI mandated that banks now need at least a 10% share in a borrower's aggregate exposure to open current or overdraft accounts without restrictions.
This is a surgical strike on cash flow diversion.
Let's break down the loophole for the listener.
To understand it, you must understand consortium lending. When a massive corporation needs a multi-billion rupee loan to build an infrastructure project, a single bank rarely takes on the entire risk.
Right. Instead, a consortium of banks syndicates the loan. Let's say Bank A, Bank B, and Bank C provide the term loan.
They hold the credit risk.
Yes.
Historically, the corporate borrower would take the funds from banks A, B, and C, but then approach bank entirely outside the lending consortium and open a current account to manage their daily operational cash flows and route their sales revenues.
Now I have to play devil's advocate here. Why should the RBI restrict this?
A lot of corporate treasurers ask the same thing.
I mean, if a corporation wants to diversify its banking relationships for operational efficiency, why force them to maintain their current accounts with the lenders? Isn't a 10% exposure threshold arbitrary and potentially harmful to smaller banks who might specialize in transaction banking but don't have the balance sheet to take a 10% slice of a massive corporate loan?
That is the exact counter-argument presented by smaller banks. However, the regulator's priority is preventing the siphoning of funds.
Oh, right.
When a borrower routes their revenue through Bank D, banks A, B, and C are effectively flying blind.
Because they don't see the day-to-day cash movements.
Right. The lenders taking the actual credit risk have no real-time visibility into the borrower's financial health. The borrower could be delaying payments, diverting funds to subsidiary shell companies, or facing severe revenue shortfalls.
And the consortium wouldn't know until the quarterly audit or the moment of default?
Exactly. The money isn't flowing through their pipes, so they can't monitor the pressure.
Wow, that's a great way to visualize it. So the 10% rule forces discipline and aligns operational visibility with credit risk.
Yes. If a bank wants to offer unrestricted current account facilities and capture that lucrative transaction float, they must have skin in the game.
A minimum 10% share of the aggregate credit exposure.
Right. If they have less than 10%, they are restricted to opening a collection account, where funds can only be remitted back to the escrow account managed by the main consortium lenders.
It ensures the lenders have their hands firmly on the steering wheel of the borrower's cash flows. It is a brutal but effective mechanism to prevent the kind of fund diversion that historically plagued Indian corporate lending.
Very effective.
And the door targeted another persistent governance loophole this year with the introduction of the reciprocally related person concept,
Yes, the master directions on this were issued in January 2026.
putting the onus of compliance squarely on the board of directors and mandating strict recusal protocols. What specific behavior is this designed to stop?
It targets a highly sophisticated, covert form of quid pro quo lending that circumvents traditional related party definitions.
Okay, let's explain traditional related party rules first.
They are straightforward. If you sit on the board of directors of Bank A cannot issue a massive unsecured loan to a manufacturing company that you own.
The conflict of interest is obvious and legally prohibited. The straightforward self-dealing is blocked.
But financial engineers are creative.
Of course. So what do?
What if we construct a multi-institution arrangement? You sit on the board of Bank A, and I sit on the board of Bank B.
Okay.
You own manufacturing company X, and I own logistics company Y. Bank A cannot lend to company X, and Bank B cannot lend to company Y.
Right.
But there is nothing stopping Bank A from lending to my company Y, provided I recuse myself from the process at Bank B when Bank B approves a massive loan to your company X.
I approve your loan at my bank, and you approve my loan at your bank. It is cross-institutional back-scratching.
Exactly. Technically, on paper, neither of us borrowed from our own bank, so the traditional related party filters don't trigger an alarm.
Sneaky. So how does the reciprocally related persons framework stop this?
It's designed to cast a much wider, more intelligent net. It requires banks to look beyond the immediate corporate structure of the borrower and map out these cross-board relationships.
It mandates that boards actively investigate whether a loan approval is part of a broader reciprocal arrangement across the financial sector.
Right. It forces governance structures to focus on the economic substance of a transaction, rather than just the legal form.
The door is clearly tightening the structural architecture of the system, from macro accounting standards down to micro-governance loopholes. But as we discussed at the beginning, the threats are increasingly nonlinear and algorithmic.
They are.
This requires a regulatory approach that understands technology natively, which brings us to our third major pillar, the fintech department.
The fintech department operates in perhaps the most complex environment within the RBI.
Why is it so complex?
Because their mandate is a perpetual contradiction. They must foster rapid technological innovation to ensure India remains a global leader in digital public infrastructure, while simultaneously preventing the ecosystem from devolving into an unregulated, systemic risk machine.
That's quite a tightrope walk. And the undisputed highlight of their 2025-26 agenda is the Free AI framework.
Huge development.
Free AI stands for the Framework for Responsible and Ethical AI in the Financial Sector. The annual report details that this framework is built upon 7 sutras, or fundamental principles.
Spanning across 6 strategic pillars, including infrastructure, policy, and capacity.
Crucially, it explicitly mandates board-approved AI policies, red teaming exercises, and strict AI incident reporting. I look at this and I have to ask the fundamental question regarding algorithmic regulation. How do you regulate a black box?
It's incredibly difficult.
Because deep learning and neural networks make decisions based on billions of parameters in ways that even their original programmers cannot fully map out.
That is the defining regulatory challenge of the decade. You cannot regulate the specific mathematical weights or activation functions inside a neural network. It is too dynamic.
So what does Free AI do?
The Free AI framework acknowledges this limitation. Instead of trying to regulate the code itself, Free AI regulates the governance architecture, the testing protocols, and the human accountability wrapped around the code.
Let's translate that into practical banking operations. How does the mandate for explainable AI, or XAI, function within this framework?
Take the process of credit underwriting. A bank deploys an advanced machine learning model to assess loan applications.
Okay.
The model is vastly more efficient than a human committee and finds correlations in the data that humans would totally miss.
Right.
However, if the AI model denies a retail customer a mortgage, the Free AI framework dictates that the bank cannot simply point to the algorithm and say, the computer calculated your probability of default as too high, application denied.
So the computer says no. Defense is no longer legally viable.
Exactly. The bank must utilize surrogate models, techniques like LIME or SAPEAT in machine learning, to isolate which specific variables drove the algorithm's decision.
They must be able to explain it to the consumer.
Yes, in plain language. They have to say that the denial was based on a specific combination of recent income volatility and credit utilization rates.
Which prevents the AI from quietly discriminating based on proxy variables for prohibited categories like race, religion, or geography.
Exactly. Explainability secures consumer rights.
But what about the systemic risk of the model going rogue or being manipulated? The report mentions red teaming.
Right. So in traditional cybersecurity, red teaming involves hiring independent, ethical hackers to relentlessly attack your own network to expose vulnerabilities before malicious actors find them.
Okay.
Free AI mandates the application of this concept to artificial intelligence models.
Wait, so you hired data scientists to attack the algorithm?
Precisely. Before a bank can deploy a new AI-driven trading algorithm or fraud detection model, an independent red team must subject it to adversarial attacks.
How do they attack it?
They will intentionally feed the model corrupted data, introduce massive statistical noise, or attempt to manipulate its feedback loops to see if they can force the model to hallucinate or make catastrophic decisions under stress.
Oh, wow. And if it fails?
It doesn't get deployed. Only if the model survives the red teaming can it go live. And crucially, by mandating a board-approved AI policy, the regulator ensures that when an AI model inevitably fails or causes a financial loss, the liability flows upward to the human board of directors.
It forces the executive suite to treat AI not as a sandbox experiment for the IT department, but as a core enterprise risk.
Yes, human accountability is key.
The fintech department is setting the rules and engagement for AI, but they aren't just acting as referees. They are actively wielding technology as a weapon.
Which is fascinating.
This brings us to Box 6.3 in the report, combating cyber-enabled fraud. The threat landscape has completely shifted from physical bank branches to vast, decentralized networks of digital fraud.
Entirely digital now.
And the RBI has launched two specific countermeasures here. First, a structural defense. The launch of the .bank.in exclusive internet domain.
This is a masterstroke in structural cybersecurity. The domain is managed by the Institute for Development and Research in Banking Technology, the IDRBT.
To understand its power, you have to look at the primary vector for digital fraud, right? Phishing.
Yes, phishing.
And phishing relies on deception. A fraudster sends a mass SMS or email with a link that looks legitimate, say hdfc-support-portal.com or agb-kyc.update.in.
And it looks very real.
The consumer clicks the link, lands on a website that perfectly mimics their bank's interface, enters their login credentials, and the fraudster instantly empties their account.
It is incredibly difficult to educate hundreds of millions of consumers to visually inspect complex URLs for slight misspellings.
So the .bank.in initiative changes the architecture of the internet for Indian finance.
Exactly. It establishes a gated digital community at the DNS level. Only verified regulated banking entities can acquire a .bank.in domain.
So HDFC Bank would move its operations to hdfc.bank.in.
Yes. Over time, as the regulator and the banks run massive public awareness campaigns, the consumer behavior shifts.
The public learns a single, unalterable rule. If the website address does not end in .bank.in, it is a fake website. Period.
It completely eradicates the ambiguity that phishing relies upon.
You build a walled garden where the consumer inherently knows they are protected by the regulator's verification process. It stops the fraud at the front door.
Exactly.
But what about the complex fraud that breaches the walls? What happens to the money once it is stolen? That requires a different kind of weapon, which brings us to MuleHunter.ai.
MuleHunter.ai represents the RBI shifting from a defensive posture to an offensive algorithmic posture.
It's a great name.
It is. It is a supervised machine learning model developed by the Reserve Bank Innovation Hub, the RBIH, specifically designed for the near real-time identification of money mule accounts.
For the listener, we should define what a money mule is. It's a critical node in a fraud network.
Right. When a fraudster steals funds, they don't transfer them directly into their own bank account, right? That would be instantly traceable.
Yes, the police would just follow the money to their door.
Instead, they transfer the funds into a mule account, often an account belonging to an unsuspecting individual who is tricked into receiving and forwarding funds.
Or an account opened using synthetic stolen identities.
Yes. The fraudster then rapidly cascades the stolen funds through a complex network of dozens of mule accounts across multiple banks.
Fracturing the money into smaller amounts and eventually withdrawing it through crypto assets or cross-border remittances.
They rely on speed and volume to dissipate the funds before law enforcement can issue freeze orders.
Human compliance officers trying to track these transactions manually across different banks are hopelessly outgunned.
Which is exactly why MuleHunter.ai utilizes advanced graph theory and network analysis. The AI model doesn't just look at individual transactions. It maps out the entire ecosystem of fund flows.
So what is it looking for?
It looks for behavioral anomalies. Say, an account that lay dormant for 3 years suddenly receives 50 microtransactions in 10 minutes, followed by an immediate consolidation and outward transfer to a high-risk jurisdiction.
Ah, huge red flags.
MuleHunter.ai analyzes the velocity of money, the geographical IP mismatches, and the structural patterns of the transaction graph to identify mule accounts with high statistical probability.
And flags them for immediate freezing across the entire banking network.
Exactly.
The RBI is literally fighting algorithmic crime with algorithmic enforcement.
It's the only way to win now.
But deploying these technologies and enforcing the rules requires boots on the ground, or in this case, algorithms in the servers. This brings us to our fourth pillar today, the watchdogs. The Department of Supervision, the DOS.
The DOS is the enforcement mechanism that ensures the blueprints drawn up by the door and the FSD are actually built to spec.
In a major structural reform a few years prior, the RBI unified the supervision of all scheduled commercial banks, local area banks, payment banks, small finance banks, UCBs, and NBFCs under one massive umbrella department.
And in 2025-26, their supervisory methodology became radically more quantitative.
We talked earlier about macro stress testing by the FSD, but the DOS implemented a highly specific operational metric for individual banks this year, forward-looking liquidity stress testing.
Right.
The report highlights a shift away from reverse stress testing to a model that predicts a bank's survival horizon. Walk us through the difference between these two methodologies.
A reverse stress test is an inductive analytical tool. It asks the bank, what specific combination of catastrophic macroeconomic events would it take to completely break your capital buffer and force you into insolvency?
Okay, so it works backward from the point of failure to identify the bank's most fatal vulnerabilities.
Yes. It is highly useful for strategic risk management, but it is somewhat abstract.
Right. It tells you what could kill you, but it doesn't give the regulator a real-time dashboard of your health during an active crisis.
Exactly. The new forward-looking liquidity stress test is acutely practical. It runs daily or weekly simulations of severe cash outflows based on real-time balance sheet data, and it outputs a literal countdown timer.
The survival horizon.
Yes. Under an extreme stress scenario, assuming no access to wholesale funding markets, how many days can this specific bank survive before its liquid assets are completely exhausted?
Does it have 30 days to failure, 10 days, 2 days?
Exactly. And the DOS maps this survival horizon directly against the extent of uninsured deposits and funding concentration within the bank.
This is a direct supervisory reaction to the endeavour of a modern bank run, like we talked about with SVD.
Absolutely. If a bank has a highly concentrated funding base, meaning it relies on 50 massive corporate depositors rather than 5 million retail depositors, and a vast majority of those corporate deposits exceed the deposit insurance limit.
That bank is sitting on a powder keg.
Corporate treasurers are highly sophisticated and entirely unsentimental. At the first sign of stress, they will pull their uninsured funds instantly.
And the survival horizon metric gives the DOS a precise quantitative trigger.
Right. If a bank's countdown timer drops below a predetermined regulatory threshold, the DOS does not wait for a quarterly review.
They intervene immediately, forcing the bank to liquidate assets or raise emergency capital.
Precision-guided supervision.
But this entire sophisticated apparatus, the survival horizons, the expected credit loss models, it all relies on a fundamental assumption, doesn't it?
That the raw data is accurate.
Yes, that the raw data the bank provides to the regulator is actually accurate. If the data is flawed, the AI models hallucinate and the stress tests produce false comfort.
And the DOS addressed this foundational issue directly with the development of the Supervisory Data Quality Index, the SDQI.
Specifically targeting Tier 3 and Tier 4 urban cooperative banks.
This might sound like a dry administrative initiative, but it is arguably the most critical operational foundation in the entire report.
Garbage in, garbage out.
Exactly. The regulator cannot effectively supervise a complex system if they are flying blind due to corrupted telemetry.
So what does the SDQI do?
The SDQI is an automated grading system for the data pipelines of smaller cooperative banks. It scores the banks on the accuracy, completeness, internal consistency, and timeliness of the regulatory returns they submit.
It forces these smaller institutions, which might lack the massive IT budgets of the major commercial banks, to modernize their core banking systems.
Right. If a UCB consistently scores poorly on the SDQI, it triggers immediate supervisory action, long before any financial stress materializes.
It is regulating the infrastructure of compliance itself.
And the DOS is applying the same granular scrutiny to the NBFC sector. They're reviewing the risk-based approach, the RBA, for KYC and anti-money laundering protocols.
Migrating select NDFCs to fully risk-based supervision models.
Yes, but what is truly indicative of their on-the-ground approach is their deployment of thematic assessments.
The report notes they conducted specific thematic audits on exorbitant interest rates and processing fees levied by NBFCs.
A thematic assessment means the DOS isn't just looking at the macro balance sheet to ensure the NBFC is solvent. They're sending audit teams deep into the operational weeds.
They are analyzing the micro-pricing mechanisms, scrutinizing the key fact statements provided to borrowers, and auditing the actual consumer impact of the NBFC's lending practices.
Right, they are ensuring that systemic stability isn't achieved at the cost of predatory lending.
NBFCs are vital for financial inclusion, right?
Yeah.
They deliver credit to the informal sectors and geographies that commercial banks struggle to reach.
But that specialized reach inherently carries higher operational and consumer protection risks. The thematic audits ensure that the risk premium charged by NBFCs is justifiable and transparent, not exploitative.
And while the DOS is digging into local NBFCs, they're simultaneously expanding their global cyber footprint. The 2025-26 report shows they inspected 15 overseas branches of Indian banks and held 12 supervisory college meetings.
Yeah.
For those unfamiliar with the term, what is a supervisory college?
When a massive Indian commercial bank operates across dozens of countries, it falls under the jurisdiction of multiple national regulators.
Right.
A supervisory college is a formal mechanism where the RBI convenes the regulators from all those host countries, say the UK, Singapore, and the UAE, to collectively assess the global risk profile of that specific bank.
It prevents regulatory arbitrage, where a bank might hide risky assets in a subsidiary located in a jurisdiction with weaker oversight.
Exactly. It is a unified front by global regulators.
The DAWs also engaged in high-level bilateral exchanges with the Monetary Authority of Singapore and the Central Bank of Russia, and they conducted cross-sectoral thematic cyber studies focusing on Security Operations Center, or SOC, operations and vulnerability management.
A bank's SOC is its frontline defense against cyber warfare.
By conducting these thematic cyber studies across multiple institutions simultaneously, the DOS is doing something vital. They are mapping the systemic cyber resilience of the entire Indian financial sector.
Right. They aren't just grading Bank's firewall. They are looking for common vulnerabilities, shared software dependencies, and systemic blind spots that a coordinated state-sponsored attack could exploit to take down multiple banks at once.
Which brings us to the inevitable conclusion of this regulatory cycle. The FSD identifies the risk, the DOR writes the rules, the FinTech department sets the algorithmic boundaries, and the DOS conducts the audits.
But what happens when someone breaks the rules?
Exactly. What happens when a regulated entity fails the stress tests, violates the master directions, or ignores the cyber guidelines? The architecture requires teeth.
It does.
This leads us to our fifth and final pillar. The Enforcement Department, the EFD, and the Consumer Education and Protection Department, the CEPD.
The structural positioning of the Enforcement Department within the RBI is a critical element of its effectiveness. The EFD is intentionally segregated from the Department of Supervision.
This separation of powers is designed to prevent regulatory capture and ensure absolute objectivity.
Right. The supervisor who audits the bank and builds a working relationship with its management is not the same person who decides the punishment.
The DOS uncovers the noncompliance and builds the evidentiary file. The EFD acts as the independent judge and adjudicates the penalty based strictly on the rule of law.
And the enforcement data for 2025-26 provides a highly revealing snapshot of where the RBI is focusing its punitive power.
The EFD issued a total of 323 penalties across the sector. Let's analyze the distribution. 13 public sector banks were penalized a total of 9.05 crore rupees. 14 private sector banks were fined 7.93 crore rupees.
Those numbers represent the massive commercial giants, but they only account for 27 penalties.
Right. The staggering statistic is at the cooperative level. 172 cooperative banks were penalized a total of 4.12 crore rupees.
That's a huge volume.
We have to parse this. The monetary value of the cooperative bank fines is relatively small, averaging a few lakhs per penalty. But the sheer volume of enforcement actions is overwhelming. What is the strategic message the EFD is sending here?
It is the numerical manifestation of the broken windows theory applied to financial regulation.
Okay, unpack that.
As we discussed regarding the FSD's stress testing, the RBI recognizes that systemic contagion can start at the grassroots. The EFD's aggressive targeting of 172 individual cooperative banks proves that the regulatory perimeter is being actively and ruthlessly policed all the way down to the smallest Tier 3 and 4 entities.
They are not just managing the headline-making conglomerates in Mumbai. They are enforcing strict compliance on local community banks operating in rural districts.
The monetary values of the penalties are calibrated to the size of the institutions, but the volume of actions sends an unequivocal message to the entire ecosystem. There is zero tolerance for operational negligence or data obfuscation, regardless of how small or geographically isolated the institution might be.
If you hold a banking license, you are subject to the full weight of the regulatory framework.
Exactly.
And ultimately, the entire purpose of this massive regulatory and supervisory apparatus, the stress tests, the capital requirements, the enforcement actions, is to protect the end user.
Yes. The foundation of the banking system is not capital. It is the trust of the depositor.
This is overseen by the Consumer Education and Protection Department, the CEPD. In 2025-26, they significantly expanded their protective umbrella by extending the RBI ombudsman coverage to rural cooperative banks.
This is a crucial democratization of grievance redressal.
Previously, a customer of a massive commercial bank had access to a highly centralized, powerful ombudsman mechanism to resolve disputes, while a farmer banking with a local rural cooperative often had little recourse if they were wronged.
Expanding the ombudsman coverage ensures that every citizen, regardless of the size of the institution they bank with, has a free, accessible, and powerful advocate to resolve deficiencies in banking services.
And the CEPD took direct aim at the friction points of the modern digital economy. They issued draft instructions to limit customer liability and unauthorized digital transactions.
Specifically, aiming to reduce the turnaround times for resolution and expand the categories of fraudulent transactions covered under the zero liability framework.
It is the necessary corollary to the digital push. The RBI is driving the economy toward digital payments, they are building .bank.in domains to prevent phishing, and they are hunting money mules with AI.
But the reality is that digital fraud will still occur.
Right. The CEPD's regulations ensure that when a consumer is defrauded through no fault of their own, perhaps due to a vulnerability in the bank's own payment gateway, the financial burden does not fall on the everyday citizen.
The bank must absorb the loss and restore the funds rapidly. It builds the fundamental consumer confidence necessary to sustain a fully digitized economy.
We have covered an immense amount of ground today.
A lot of ground, Jess.
From the predictive macroeconomic modeling of the growth at risk framework and climate transition risk to the brutal mathematical reality of the expected credit loss accounting standards.
A massive shift.
We explored how the regulator is forcing banks to hold more liquid assets through LCR haircuts to survive digital bank runs, and how they are utilizing advanced artificial intelligence like MuleHunter.ai to map illicit financial networks in real time.
We have seen a central bank that is simultaneously simplifying its rulebook and vastly increasing its technological capability.
It is a masterclass in regulatory evolution.
But, if I may leave our listeners with one final provocative thought based on the trajectory we have analyzed today, it is this.
What's that?
The RBI is explicitly moving toward automated AI-driven supervision. They are deploying algorithms to track fraud, grade data quality, and run real-time survival horizon simulations.
Yes, very heavily reliant on tech now.
Simultaneously, through mandates like the Free EAI framework, they are forcing the banks themselves to deploy and govern highly advanced machine learning models for credit underwriting and risk management.
Right.
As we look a decade into the future, we are rapidly approaching an inflection point where AI models are making the microscopic credit decisions inside the banks, and the central bank's AI models are continuously supervising and stress testing those banking models. When the financial system reaches a state of autonomous, machine-level regulation, operating at speeds entirely beyond human cognition. What exactly is the role of the human regulator, other than to decide when to pull the plug?
A fascinating and frankly somewhat terrifying thought to end on. From building static stone walls to engaging in algorithmic warfare, the defense of the fortress looks entirely different today. Thank you for joining us on this deep dive. Keep questioning the mechanics of the financial world, and we will see you next time.